Hey everyone, welcome to another episode of ADMAIL. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of ADMAIL. I'm Adam Bergman, tax attorney, founder of IRA Financial. And on today's episode, we're going to tackle questions on Roth IRAs, reporting Roth IRAs with IRS Form 5498, and opening a self-directed solo 401k account to do private placement investments. So buckle up. It's going to be a really fun episode. I'm going to get right to it. So let's rock and roll. First question is from Rod N of Snowmass, Colorado. And Rod wants to know, I did a Roth conversion a few years ago at age 62 of a piece of real estate in Colorado. I'm thinking of selling the property for a gain of over $250,000. Nice. Would I owe tax on what I pull out of my Roth IRA? So Rod's asking a really great question, and it brings in to bear a few issues involving Roth IRA conversions. So Roth IRA conversions are treated somewhat different than Roth IRA contributions when it comes to distributions. Roth IRA contributions can be taken out anytime you want. So if you put in $100 in a Roth IRA today, you can pull it out tomorrow tax-free. From a conversion standpoint, if you're over 59 and a half, whatever you convert, you can pull out right away. But if you're under 59 and a half, whatever you convert, you have to wait till you're 59 and a half to pull out tax-free as a tax-free distribution. So in case of Rod, when you have a Roth IRA, there's no tax, right? So if you have a property for $250 and you sell it for $500, your $250,000 of gain will go back to your Roth IRA without tax. But if you want to then pull the money out of the Roth IRA and put it in your pocket, generally, to have a qualified Roth IRA distribution, you have to be over the age of 59 and a half, and the Roth IRA must be open at least 5 years. So it's an and test. It's 59 and a half and 5 years. But from a conversion standpoint, if you convert 100K from pre-tax IRA, pre-tax Roth, if you're under 59 and a half, in order to pull that 100K out, you generally need to be over the age of 59 and a half. To get all the earnings out, you do 59 and a half plus the 5 years. So Rod's over 59 and a half. So when he converted the amount, he could pull whatever he converted out of the Roth IRA tax-free. Earnings need to be at least 5 years. Okay, so he's going to have to wait several more years to pull those earnings out because he needs to satisfy the 5-year rule. So Rod, thanks for the question. It's a really, really good question. And I get these Roth IRA questions all the time, especially because people get confused between the conversion and contribution rules regarding tax-free qualified Roth IRA distribution. So thank you so much, Rod. The second question is from Paul B of Winter Haven, Florida. And Paul wants to know, I have a Roth IRA with IRA Financial. When do I get a copy of IRS Form 5498? So it's a really good question and a pretty short answer. The answer, Paul, is IRA Financial files 5498 with the IRS, which is essentially an IRA information report. It's not even a return. It's quite short. It's generally due the end of May for the previous year. We file it. You don't need a copy. Okay, this goes to the IRS. The only time you are going to need to report anything regarding an IRA on your 1040 individual tax return is if you take a distribution or if you make a contribution and want to get that taxable deduction. But otherwise, the 5498 goes straight to the IRS. It's basically a report card to the IRS that kind of lets them know the status of your IRA, if you made a contribution, if you took a distribution. We also provide the value that you provided us, and then we indicate based off category of investments what the IRA is invested in. So it's basically just a quick snapshot and overview that the IRS receives. Paul, you don't get a copy of the 5498. You can see it if you want and go in our app in your account and get a copy of it, but your accountant's not going to need a copy because the only thing your accountant will need is the amount you contributed, which I guess technically could be on the 5498. And if you took a distribution, which you can disclose to your accountant as well. If your accountant, for some reason, is asking for a copy of the 5498, that's perfectly fine. You can ask us and we will provide you a copy, but you don't need one. Okay, so there you go, Paul. I told you it's going to be a short and sweet answer to a really, really good question. Third and final question of today's episode comes from Kenneth R. of Melville, New York. Kenneth wants to know, I have a solo 401k with a brokerage firm, but I want to do a private placement and the brokerage firm will not let me do it. Can I set up an account at IRA Financial and do I need a plan? So great question, Kenneth. Another great one. I actually got this question. I'm not sure if it was from you. Maybe. Actually, about a week ago, it was forwarded to me for someone in our compliance department. And it's kind of the same theme of a question. So that particular question, just like you, Kenneth, had a solo 401k. I think they had it at Fidelity or Vanguard. And they wanted to do a private placement on a crowdfunding platform. I think it was like Yield Street. And they asked their brokerage firm to do it and they wouldn't do it. Why? Because brokerage firms don't make money when you do private placements, right? So they're not going to let you do it. Their plan that they provide to you is free. You can get a free solo 401k anytime you want, a Vanguard, Schwab, Fidelity. The only thing is it's going to let you do only what investments they offer. So generally equities, mutual funds, ETFs. In some cases, these free plans won't even let you do conversions or Roth contributions and certainly not even do a loan, right? So it's a pretty vanilla type basic plan. Works for many, many Americans. It doesn't work for others. In your case, Kenneth, what you're going to need to do, it's actually quite similar, is you're going to need to go on our app and open up just a regular solo 401k plan. We don't need to set you up with a new plan. Okay, you already have a plan. All we're going to need to do is set up a account for your solo. You'll roll, if you're able to roll the funds out of, well, it's actually not even a rollover, right? It's just an in-plan transfer. So you're going to just move the money from Fidelity to IRA Financial, and then IRA Financial will fund your private placement investment. The plan is not changing, right? We're not changing the name. We're not amending the plan. All we're doing is opening a sub account for the plan. Now, Fidelity, Schwab, they don't file the 5500 EZ for the plan. You do. You know, unlike the IRS Form 5498, which is required to be filed by the IRA custodian on behalf of the IRA owner, case of a solo 401k, the trustee or plan administrator, you will file the 5500 EZ, not Fidelity or Schwab or whatever brokerage firm you use. So as long as you're going to keep track of the values of the two accounts, one with IRA Financial that has the private placement and the other one with your brokerage firm that I assume has equities, you can do it. You just aggregate the value and you'll file the 5500 EZ. You don't need a new plan. You don't need a new tax ID number. You don't need to amend it. Super easy and simple, Kenneth. And the only thing to keep in mind is to make sure that the brokerage firm that's moving the money isn't going to somehow treat it as a taxable distribution. So when if there's a 1099-R, which they shouldn't even report it because it's an in-plan transfer, right? You're not rolling it to a new plan. You're not rolling it to an IRA. You're just moving it from basically one bank account to another, right? Just like if Apple Computer is moving money from Chase to Bank of America under the same company, it's not a taxable transfer. Same thing here. It's still staying in the plan. It's just literally going to a new firm to make this investment. So the only tricky part is make sure the brokerage firm you're using is not going to treat it as a taxable distribution or report it. If they're going to report it, at least let them put in a 7 in box 7 code G. So put in a G as in girl in box 7 in the 1099-R, but they shouldn't have to issue a 1099-R because it's an in-plan transfer. So there you go. Thank you for that question, Kenneth. And thanks to everyone that's sending questions. I got a lot of great questions in the queue, but if you have an idea, have a question, don't be shy. You can send it in. I won't even use your name. You can just say, keep it anonymous. You can send it in to info@IRA Financial or just hit us up on social media, YouTube, Twitter, Instagram, LinkedIn, whatever works for you. Just put in the subject line, ADMAIL or Ask Adam, and it will get to me, I promise. And if it's really good, I promise I will skip the line and get you up to the front and answer your question, hopefully sooner rather than later. So thanks again for listening. If you're watching on YouTube, thank you as well. Don't forget to subscribe. It's a weekly podcast that drops every Thursday. So hopefully you'll check it out again next week. Have a great week and take care.